Hello, everyone. I had to laugh. EU consumer confidence, right? The economic headlines on the day, the media headlines, are surprisingly deteriorated. It's been nothing but a sea of red for a couple of years now, the European Consumer Confidence Morale Index. And why wouldn't they be depressed? They've got a war on their footstep. But those in the financial markets like to compartmentalize geopolitical conflicts as if they don't really matter in their lives every day, and therefore they assume they don't matter in everyone else's lives every day. But of course, consumers and small businesses are going to make decisions based on how secure they feel about the future, and you don't generally, as a human being, feel very secure when you have a major war taking place in your region, and it could escalate at any time, but we trust that it won't. But of course, consumers are going to be a little bit mindful of that. Small businesses, big businesses are going to be a little bit mindful of that. But in the financial markets, no, it doesn't worry, it doesn't matter. We're just getting on with life. And, that's a video game that happens over there. I'm sure it's not like that in the financial markets. But to some degree, there is this, let's stay positive about stocks and the stock market, and let's pretend geopolitical wars and conflicts and tragedies aren't happening. As, for instance, in the US, the number one cause of death now in the US between the age group of 18 to 45 for male and female is drug overdose. It's overtaken cancer and heart disease, but economists don't like to think about that and what sort of impact that's having on the economy, Main Street, either. And it is having an impact, of course. And, consumer sentiment is rock bottom, and it's a bit of a feedback loop. There's so much stress and concern in the US economy. I've mentioned before, people think the average wage in the US is $65,000, but if you take out the top 10,000, it's only $35,000. 90% of Americans are living on an average of $35,000 a year, and you wonder why consumer sentiment is below COVID lockdown levels. Speaking of below COVID lockdown levels, that was the result also for US existing home sales, which bounced for the second time in like a year, and up to 3.95 billion. Actually, they've been doing a little bit better than that. I shouldn't say that, but up 1.3% in July, but still well below COVID lockdown levels. So existing home sales, people are buying less houses than they did, yet less existing houses than they did when they were in lockdown. How bad is that? All of this economic data, Chicago out yesterday, Chicago Fed National Activity Index down again. It's contracted. The National Activity Index from the Chicago Fed, it's a national activity index that the Chicago Fed does. It's been negative 8 of the past 12 months, and all this time, people in Washington have been telling us that the economy is strong. People on Wall Street have been telling us the economy is strong. How does that add up? 4 of the past 6 months, contraction. We had the Kansas City Manufacturing Index. Again, this is another economic data, second bounce out of the last 12 months. There's got to be some stabilization in the US manufacturing sector because it's basically been in a depression for 2 years, contracting. So it's so reduced, so minimized, that it's got to stabilize at some point, surely, or else we are headed in, to another Great Depression like 1929. And as for all those people who keep saying stocks always go up, you can just keep buying, not a problem. There have been many instances where it's taken 3 to 6 years for the US stock market to recover to where it was previously if you bought at the high. And in 1929, it took 25 years to get back to break even, still no return if you bought stocks, towards the end of 1929 or just before the 1929 crash. So if you're willing to wait a generation for your stock buying positions to come back, yeah, believe that. It always goes up. You can buy anywhere. So the ECB didn't cut rates. And there's a little bit of a warning here on what might happen with Federal Reserve. They're not in a rush. Yes, they'll be cutting rates, but they're not in a rush. Federal Reserve is going to cut rates, but as I made yesterday, they're not going to be cutting rates by big slabs. Is a 50-point rate cut possible? No. It would be seen as so political, it would be the end of any credibility for the Federal Reserve. So they'll be cutting 25 points. I think they'll get 2 25-point cuts in this year, maybe a third. So I'm 50 to 75, but there's a whole lot of people in the market, the Wall Street group thinks, spin masters, who are telling you there's going to be over 100 points in rate cuts this year, just like they told you every other year for the last 3 years. There were going to be 150-point rate cuts when rates kept going up. Anyway, that's that. Markets. Stocks look very soft. They're rolling over. They really are. Okay. We called the mini crash. Didn't expect the bounce would be as big as it is, but it's looking tired. And this is how I think it's going to work in the US stock market, actually. A little bit of an intuitive insight here. So basically what's going to happen is, you know how the big three basically control 88 or 89%, 88% of the US 500 index stock holdings. But, you know, obviously the stock market's a lot bigger than that. US Russell 2000, by the way, looks very, very heavy. EU looks heavy as well. I just sold Louis Vuitton, Moet Hennessy yesterday, and I also sold Porsche. I could be wrong. That's what I did. But on what I think is going to happen is those big three funds. Within those funds, there's thousands of money managers all acting supposedly independently, but of course it's always about the Wall Street group think positive spin. But some of them are going to start to think, oh, maybe I can move my career ahead if I don't lose as much money as everyone else in a bear market, so I might sell some stocks. And if that starts to spread as a sentiment within one of these big three fund managers, then equity markets have probably topped, and it's just the beginning here. So, and if that spreads to two of those big three names and to three, you've got Armageddon. You've kind of got 1929. And I'll say it again. In 1987, I had my best month ever in October 1987. In that month, the Australian stock market fell 52% in 3 days. 52% in 3 days. Oh, and by the way, waterfront property around Sydney Harbour dropped 50% for a period of 6 to 18 months as well. That's not going to happen this time. Touch wood. What I'm trying to do is stretch your imagination and make you aware of things that the Wall Street group think doesn't want you to be aware of, or your superannuation fund manager or your financial advisor doesn't want you to make you aware of. They want you to buy more more fund management products. So have a look at my website, of course, because now I'm going to do a sell. Have a look at my website, cliffordbennett.com.au. My macro A is up 4.5% this month when the market's, I think, flat or down. And I'll have to check the number. But what I'm saying is you can make money in bear markets. So I'm not like giving you bad news here. I'm giving you an opportunity. So keep that in mind. Anyway, thanks very much for listening in. Have a great day. I'll try to make these as content rich and entertaining as possible. All the best for Friday and your weekend. Enjoy your family and friends. They are all that matters. Take care.